Before I go into Alibaba's bad news, let me introduce you some of the most interesting traits of Warren Buffett. So, this is an article from Outsiders, and here it's talking about Buffett. For those interested in a deeper dive into Buffett's stock market investing, two other patterns are worthy of notice. And he's talking about a deep rooted contrarianism. So Buffett has frequently talked about this Mr. Market. And this Mr. Market, which was coined by Benjamin Graham, shows up every day to either buy or sell from you. And the more manic depressive this chap is, the greater the opportunities available to the market or to the investor. You're basically talking about if you find a beaten down security which others are not beating in, that could be a very good opportunity for you. The majority of Berkshire Hathaway's major public market investments originated in some sort of industry or company crises that obscured the value of a strong underlying business. And this is the most important point, which we're going to cover now. Now, starting with 1963, this was the famous salad oil scandal. But there was this gentleman, this guy, Anthony DeAngelis, and he was a scam artist. And he started this company for basically selling or the soybean scam. And he wanted to do a scandal out of it. So he opened a warehouse, he bought all the soybean, basically creating an artificial demand and increasing the price of soybean. And at that same time, American Express and all these different banks were going into the business of lending loans to warehouses if they had good inventories. This guy, what he did, he went and he created tanks and tanks of, instead of pouring oil in it, he put water in it, seawater. And on the top, he put oil. And we know that oil floats and oil is on the top and the water stays on the bottom. So whenever people came for investigating, they would look at the tank and they would go on the top and they would test the surface of the water. And instead of water, they would find oil. And they all thought, hey, this guy has about 150 million gallons of oil. And basically, you can go ahead and give him money. So they all started giving money to this guy. But it all turned out to be a scam until someone came to find out. So basically, all these loan companies, they started to fall down like anything. And American Express was beaten down like crazy. And that's when Warren Buffett, he went in, he saw the annual reports. In that letter, he saw that American Express was not fully liable for those losses. They could pay, they could pay or they could not pay. It was up to them. And only as a goodwill, American Express paid about $45 billion. But they had a very strong business in other lines of interest that was already going on when people failed to see it. So he invested about 40% of the partnership's money between 1963 and 1966, and he got a huge return. Basically, it was trading at about 78% discounted value of the intrinsic value, and he made a huge return on that. This is just one. Then there was this scandal back in 1973 where they were trying to purchase one of the broadcasting channel or licenses from Washington Post. This was all involved in that Watergate scandal that was also going on, and the stock was being beaten down. That's when Warren Buffett came in. He saw this was just the facade, this was the outside story. He went in and he bought the stock in huge chunk. Then came in the Geico bankruptcy. Back then, this was 1976, and people thought with the status of Geico and problems that they were facing, this would go into bankruptcy. But Buffett had a very good attachment with it. He had a very good stake back in 1950 when he was with Ben Graham. In 1976, he came in and said, hey, I love the business. I love the app or the fundamentals and how you're operating. It's just that it's being managed incorrectly. And he came in and he purchased. He took the whole share out there, and it ran very well for him. Then came Wells Fargo and the California recession. This was back in 1989, and California was going through a downturn. And that's when the Wells Fargo stock was also being beaten down. Again, Warren Buffett came in and he bought it. You can start to see a pattern with him. Wherever these crises and wherever these problems came in, where people became so fearful, and I mean, he became greedy at that point, and he started purchasing like anything. Then came 2008, the recession, the big crisis that most of us are aware or have witnessed it. You can see, and that time he invested about $5 billion in Goldman Sachs. That time, Goldman needed it because that was taken as all the financial institutions were failing, and this money from Warren Buffett helped a lot. And he made a good chunk of money, about $3.7 billion right there and then. Then next came the 2008 Dow Chemical. He put in another $3 billion in that for the takeover of Dow Chemical, made huge money on that. Then came Mars and Wrigley. They both were buying. So Mars was buying Wrigley, and they took Warren Buffett's help in about $23 billion. And that, again, it was during the 2008 recession. And the whole market in general was falling down. And there was a very good time to buy companies. And they purchased about $23 billion of Wrigley's for Mars. Then now we're talking about Alibaba, where the China crackdown is basically trying to hurt the Alibaba stock, and it is hurting considerably. The stock lost more than 50% of its value from 300s, and now sitting at about $160, $170. But you can see the earnings, the underlying fundamentals of the company is a different altogether, and it's going out and it's growing altogether in a different pace already. So these are some interesting things to look into. So again, this is a very good article showing the whole philosophy of investment, where you are trying to find these special moments in time. And this is a patience game, and these moments won't come in every day. You can see that this investment happened in 1963. This happened in 1973. This was in 1976, 1989, almost decade-long instances when these moments came in and provided value for themselves. So yeah, found these interesting, found the pattern here, and just wanted to share this with you. Again, there could be some bias here. We could be wrong in analyzing this situation. This could be a facade in itself, where the earnings could not be working out in that way, and this could whole be in the wrong direction. But do your own research, do your own understanding, think about it, read as much as you can, do your own research, and you'll be fine. With that, take care, stay safe, bye-bye.